Welcome, everybody. My name is Alexander Black. I am a senior from Saugus High School.
And my name is Jacob Monreal, and I'm also a senior from Saugus High School.
And today we will be discussing the financial statement analysis for Target.
So a little overview of what we're discussing today. We are highlighting Target's key changes in the financial statements from February 3rd, 2024. We are identifying the overall financial condition of the company, and we are providing a strategy for upcoming business decisions and opportunities for growth.
So before we dive into Target's financial statements, we want to prepare you guys with a little bit of vocabulary that we will be using. So firstly, our consolidated statements of financial position. This includes the balance sheet, which provides a snapshot of a company's financial position at a specific point in time. It shows what the company owns, aka its assets, what it owes, its liabilities, as well as the remaining value for shareholders, aka the equity.
Secondly, our term is consolidated statements of operations. And this is the income statement, which shows a company's financial performance over a period of time, detailing how much revenue it earned, what expenses it incurred, and whether it made a profit or loss.
The next financial statement we will be reviewing is the consolidated statements of cash flows, which is a statement that tracks how cash moves in and out of a company, as well as helping assess its ability to generate cash and fund its operations, investments, and financial obligations.
Our last financial statement is consolidated statements of shareholders' investment, and this statement shows changes in ownership value over time, detailing how profits are retained, dividends are paid, and shares are issued or repurchased.
So going into Target's consolidated statements of financial position, firstly, we will assess its cash. Now, as we can see from our data here, the cash from 2023 to 2024 has increased by 1.7 times, showing the stronger cash generation. In addition to this, we see that the inventory costs have gone. We see that the inventory has a 0.88 times decrease from 2023 to 2024, reflecting better inventory management. In addition to this, we see that the property and equipment from 2023 to 2024 has seen a 1.05 increase, showing more investment into our assets, as well as a decrease in our long-term debt, showing better financial stability and debt management, as well as an increase of 1.04 times from 2023 to 2024, showing more economic stability within our assets. Now, if we look at our assets to our liabilities per the years, we see in 2024, the ratio is 0.91 assets per liability. And in 2023, the ratio is 0.92 assets per liability, showing a downward trend in our liquidity.
So to move on, for our consolidated statements of operations, sales decreased by 0.98 times, indicating a slight dip in revenue. Also, cost of sales decreased by 0.95 times, helping maintain profitability. And selling, general, and administrative expenses, this increased by a multiple of 1.04 times, reflecting higher operational costs. And our operating income surged by 1.48 times, driven by cost efficiencies and operational improvements. And lastly, our net earnings rose by 1.49 times, which demonstrates strong profitability growth.
In addition to this, we will be reviewing Target's consolidated statements of cash flows. Now, firstly, I want to talk about the cash provided by operating activities. We see from 2022 to 2023, there's a 2.15 times increase in this cash, showing the stronger cash flow from core operations. In addition to this, we can see that the cash required for investing activities has gone down by 0.86 times from 2022 to 2023, showing that there's lower capital expenditures. And in addition to this, the cash required for financing activities has been raised by 1.04 times from 2022 to 2023, reflecting potentially dividend payments or debt repayments.
Lastly, I'll be talking about consolidated statements of shareholders' investments, and I'm comparing 2023 to 2024. In short, we had a 1.06 times increase, which suggests that while the company values returning cash to shareholders, it may be prioritizing other other financial strategies like reinvestment or debt management, which limits a larger dividend hike.
So me and my colleague have come up with our financial condition of target, which we unanimously agree, that despite a slight decline in their sales, the company showcased strong financial growth with significant increases in net earnings, operating income, and cash flow. The reduction in debt increase in total assets further strengthens the company's financial stability. However, the decline in the current ratio suggests that liquidity, should be monitored closely to ensure short-term obligations are met efficiently.
So what are we doing for the future? Right? We're going to diversify revenue streams, explore new markets, products, or services to counter sales decline. We are also going to expand digital and e-commerce. We are going to invest in online sales channels and marketing. And for customer retention and acquisition, we will implement loyalty programs, personalized marketing, and targeted promotions. And lastly, we will ensure sustainable growth by focusing on revenue strategies while maintaining liquidity and managing expenses. And for improving operational efficiency, for cost optimization, we will reduce non-essential SG&A expenses to improve margins. For lean inventory management, we will optimize supply chain efficiency to prevent stock shortages. And for technology investments, we will utilize AI and automation to enhance productivity and reduce costs.
If you guys have any questions, please email us at these emails provided. And thank you so much.
Thank you for your time.